everyone has been getting totally smashed, especially S&P Mag 7 types. Guys who are still bag holding Tesla and Bitcoin right now are getting totally smashed. In this video, we're going to be talking about a trade which I took, a trade which pays off, a trade which makes you money in a situation where you don't know what's going on. In this video, we're going to be talking about a bear market hedge type trade, which I put on about a week back on Newmont Gold, where I got paid off in a 7 to 1 trade, one headline, one structure. As you can see, we're going to be breaking down the Newmont Gold position I had on. Of course, I had Century Aluminium too. That was another winning position I had on. But in this, we're going to be primarily focusing on Newmont Gold. So, this setup. Last week, Jerome Powell gave a speech at Harvard. Now, in that speech, he basically just said that he's willing to ignore the inflation shock which is caused by this insane oil price. That was essentially a dovish outlook, and that's when I got this trade idea. I knew that if Powell is actually dovish, and because we also had a dovish jobs report last week, combining those two factors, that is a good case for the US 10-year bond yield to come down, which usually translates into gold outperforming in that situation. So, a dovish Fed outlook paired with these crazy job report numbers, and in this inflationary environment, combined with Trump saying stuff on Truth Social, is a perfect cocktail for a gold market rally. In a situation like this, in a situation with such crazy uncertainty, with real yields coming down and the dollar coming down too, perfect environment for gold to rally. Which is why I started looking heavily into gold positions, into gold futures and the gold volatility setup. Now, what would a retail trader do in this exact same situation? A retail trader would probably just see now that gold is going up, would probably buy shares as in stocks, have linear exposure to it. The risk is that the price moves against him. He hopes and he bag holds. If it does move in his correct direction, maybe he makes a 20% return on that trade. Good for you. What a professional trader does in this situation. A professional trader wouldn't just look that gold is going up. A professional trader would look at conviction. He'd see that, okay, we have gold going up. He's probably going to look at gold volatility. Again, we have gold volatility coming down. So IV comes in, which is another bull case for gold. One more thing he slaps into his thesis. He wants more exposure to this bet, and if he's right, he wants to make a ton of money. So what he's going to do in that position is he's going to look at gold miners, or instead of NEM, he's probably going to look at GDX, and with that, top holdings NEM. And that, he puts on a call structure on Newmont Gold. Off the lows, rally to the top, 25%. Boom. With the call structure he put, as the one you can see in the screenshot right here, this call structure, he gets a payoff of 7 to 1 on that trade. The professional trader doesn't know what's going on. He just trades based on conviction, and he trades based on his payoff diagram, payoff structure. In this situation, he made a 7 to 1 return in that trade. The position, Newmont short dated out of the money call structure. Now, buying naked calls outright, that's just something professional traders wouldn't do, especially in an environment where we have gold volatility so high right now. You wouldn't buy short dated call options at all. You'd be killed on the theta decay, and it's super expensive calls anyways. So what a professional trader would do is he'd probably construct a ratio calendar bet or just a vertical structure, short dated, 30 days out, to reduce gamma kill, or just so that it's not as sensitive to decay. That's what a professional trader would do. A professional trader is also, so the professional trader has high beta to gold, IV coming down, catalyst loaded window, and operational leverage. Newmont Gold has insane operational leverage. Cost small, payoff insane. That is what you call convexity. That is a trade you should have in your book at all times. A tail risk type bet. A hedge to your book where say like everything your short starts spiking up. Now imagine the guys who just like short the S&P 500 stock, and you get like a 4% move in the last 2 3 days, right? That guy, he's gonna get squeezed hard. He needs positions like these in his book so that he at least stays hedged out and maybe even makes some money in a situation like this because the hedge pays off so crazy. Professional traders have this tail risk hedge bet on at all times in their books. One headline, five lives, one payoff. You don't need to know what Trump tweets. If anyone provides you a solution with, how do you actually, predict like what Trump's gonna tweet, that's insider information. Unless you're one of these fraud guys on Wall Street who are actually, indulge in like insider trading, then you could probably front run stuff like that. But we're just normal guys making money in the financial market, right? So you don't need to know what Trump is going to tweet. You need to be standing where the domino falls. So, two-year yield collapses as soon as Jerome Powell gives his speech at Harvard. Real yields collapse, dollar sells off, gold spot pops instantly, Newmont gaps up higher beta, so more leveraged, more leverage to the gold move, right? IB expands on Newmont gold options. Out of the money calls go in the money. Vega kicks in. Position prints multiples. That's the exact chain which we were hoping for, and that's what we got, and that's how we got that killer return. Same thesis, different maths. Buy and hold pays you in a straight line. A structured trade pays you in an exponent. Buy and hold doesn't lose because the thesis is wrong. It loses because the structure has no convexity. Let's look at these numbers. Now, if you were wrong on that buy and hold trade, you would have probably lost 10% on that trade. If you were right, maybe you've made 10%. Very right, 30%. Out of the money call options. If you're wrong, you lose 100% of the premium. Assume you're trading with $100,000 and you lose $5,000 on a trade like this. That's nothing. That's like a 5% drawdown in your book. Are you really willing to give over like 15% of upside for a 5% drawdown? This is the bet professional traders take. They have a positive expectancy in their book at all times. And this trade is the perfect example of what professional traders actually do in their books, how they structure trades. The bag holder loop. It'll come back. I'll average down. Diamond hands. Long term, gold's gonna go up, right? Long term inflation is gonna come. I'm just gonna leave it for my pension. No. The bag holder problem isn't bad picks. It's you don't have any defined risk. You don't have any convexity. There's no catalyst clock. And you actually have a huge ego. Your identity is more important to you than your P&L. You're a long-term bull. Michael Saylor types. Buy and hold is a religion. Tail risk insurance is a job. Now in summary, the whole game in 3 steps. Read the setup. What did the Fed actually signal? What is the bond market doing? How did the move index react? How did the gold futures react? Gold volatility index. Find the asymmetry. Where is vol cheap relative to the catalyst? Structure the convexity. Define the loss, uncap the gains. Have exposure to crazy gains. Powell handed the market a setup. The market handed me a payoff. If you want to learn how to actually build trades like these and find ideas like these where you use modern economics, right? All the stuff, the 10-year bond yield, the 2-year bond yield, the 10s minus 2s, credit market, rather than being an economist and rather than watching the full yield course again of the Schiller house prices and all that stuff, if you want to know how to actually use these macroeconomic indicators to actually generate trade ideas timed to the T, subscribe to my channel. This is exactly what we talk about all day on my channel. How professional traders look at professional setups, how they look at these sovereign bond indicators, and how they actually come up with god tier trade ideas, just like this one.